Now let's welcome my next guest, Eddie Ghabour. Eddie is the co-owner of Key Advisors Group in Lewis, Delaware. He began his career in financial planning in 1998, focusing on retirement and estate planning strategies and specializing in money management. Eddie, thanks for joining us today. It's great to see you.
Thank you for having me. I appreciate this.
You know, every time I turn on Fox News, you know who I see?
Who's that?
I see you sitting with the panel. You're a new star on there.
Thank you. It's been an honor being asked to be on these shows, and it's a humbling experience, but I'm truly having a lot of fun doing it, and hopefully giving a lot of investors some good advice that they can take in their own financial plans.
Well, I find your comments always very helpful. But today, we're going to talk about some things that are affecting the stock market and some concerns that we have. The theme of our show today was corporate stock buybacks. And what we've noticed, Eddie, historically, is that there's usually some type of a bear market divergence when corporate stock buybacks peak. And I'll refer back to 1999 when they peaked, before the dot-com collapse, and 2007 when they peaked. And so now we had a peak last year of $1 trillion. And prior to last year, corporations were buying back an average of $50 billion a month of their own stock starting in 2010, and the majority of those purchases were leveraged. In other words, they bought that stock with somebody else's money, not money off their balance sheets. And so tell me, do you think there's going to be a bear market divergence? Because I know you're a bull, and that's okay, but I want to hear about what your concerns are, because there are correlations to corporate stock buyback peaks. So tell me your thoughts.
Look, there's without a doubt, I can't deny the fact that there's correlations there. And yes, I've been very bullish over the last several years, as you well know. But look, we do know all good things eventually end. So this bull market's not going to run forever. And so I agree with you to a certain extent in regards to the corporate buybacks. So much demand coming from corporations that if you extracted that $1 trillion of buybacks, stock prices wouldn't be as high as they are today. So naturally, when you start to see a decline there, that's going to be a red flag for stock investors to maybe possibly reduce the risk that they're taking in their portfolio. What concerns me the most is what you talked about, leverage. I think that leverage and corporate debt side of things is a bigger concern to me, frankly, than the buybacks, because we know that when people get over leverage, it's just a ticking time bomb. So as long as corporate buybacks stay strong, which they still are, I'm not disputing the fact that they may have peaked last year. I don't see a crash here short term, but over the next few years, you have to question how long this bull market can run.
Well, there's still some legs in the bull market, isn't there?
There is. The fundamentals for this year still look good. After the decline we had in the fourth quarter, I felt really good coming into 2019 that we would see double-digit growth in the S&P. Obviously, it's on track for that, but it's still really, really early, so we'll have to wait and see. I think volatility is going to be here to stay, though. So these double-digit drops we're seeing throughout the year in the market are here to stay, but I think 19 can be a very profitable year for the stock market.
Well, I agree with you, Eddie. We are still at a point, though, in the markets where we're still 10% below the peak. We dropped 19.8% from the peaks last quarter, and so right now we're playing the catch-up game. So for now, the stock market money might be dead money unless it can come back to the peak and approach that ceiling. Now, we're going to stick around and be right back with Eddie Ghabour after our break. Welcome back. We're talking with Eddie Ghabour, the co-owner of Key Advisors Group in Lewis, Delaware. Eddie, thanks for sticking around.
Thank you.
Let's talk about your new book, Eddie. You're a brand new author. You've got a book coming out called The Common Sense Bull. Is that a loaded question? Joking around. The Keys to the Good Life Before and During Retirement is the rest of the title. In your new book, Eddie, do you identify the frame of mind and strategies required to not only survive, but thrive in today's markets? Could you tell us here a little bit about that at the Income Generation?
Yes, I'd love to. So the book that we've just come out with is going to share a lot of the core principles that we've used in our practice for many years to try to help guide people throughout the rest of their retirement, and talks about some of the fundamental approaches that we've used. One of the biggest keys in this book is talking about risk management. We constantly talk about risk management here at our firm with our clients. Look, it's well known that I've been a bull for a long time, and I'm still a bull, but I have never put my clients in a position or think it's prudent for them to put a very large percentage of their investable assets in the stock market when they're retired. And so many people are walking around with a portfolio of 60% stocks, 40% bonds, and think that they're protected. And then when the market crashes, they have a correlation usually of 70 to 80% of the market, which is much higher than what they think. So we talk about some of the things to look for in a portfolio to clearly understand the risk you're taking. We talk about things like on the stock side, being a little bit more defensive and investing in companies that pay dividends and, more importantly, have a history of raising dividends. Traditionally, those types of companies have had less volatility than your technology companies and your high beta stocks. The other thing we talk about is really being disciplined and not making emotional decisions with your investing. This fourth quarter was a perfect example. I'm sure anyone that panicked and sold everything out of the market is probably kicking themselves right now. But had they had a good risk management plan in place and were disciplined and have a coach to be able to bounce ideas off of, they probably would have just stayed the course, and now they're looking just fine.
Sure.
So I'm hoping that this book will educate them in many ways.
Sure. That's awesome, Eddie. I can't wait to get a copy and read it. What role, though, do you think sowing corporate debt and stock buybacks will play in the next big shake-up in the financial markets? What will the impact be?
I think the corporate debt side is the thing that I have as the biggest concern from the stock market, okay? Look, leverage is really good when the economy is growing like it is and when we're not in a recession and when interest rates are low. But when interest rates rise and the economy slows down, that corporate debt is going to be a problem. If I had to pick one area that will cause the next major drop in the market sometime in the future, it's corporate debt. Because as you know, sometimes people ignore the discipline of not over leveraging when things are really good, but they don't stress test their balance sheet. So when rates go up, these companies are going to have a very hard time.
Eddie, I got to cut you off. I completely agree with you. I couldn't agree with you more. I think corporate debt is the next time bomb. I want to thank you for joining us today, and I can't wait to read your book.